In case it wasn't already obvious, we're now at the mercy of the bear market that began with the 10th of October liquidation event last year. But could this bear market have been triggered by one particular cryptocurrency that's tied to a certain US president? Well, that's exactly what a recent report claims, and it's safe to say that its findings are truly eye-opening. That's why today we're breaking that report down for you in simple terms, explaining why we're in a bear market and looking at what could happen next. My name is Guy, and you're watching the Coin Bureau. So, the report we'll be summarizing today is titled, quote, "Coincidence or Signal? Did WLFI telegraph crypto's $6.93 billion meltdown?" It was published by Amberdata, a leading data analytics platform, and as always, we'll be giving you the juiciest details right here in this video. But we'll leave a link to the full report down in the description for you if you want the whole enchilada. Now, in case the title didn't give it away, the report's primary focus is WLFI, the governance token of the Trump family's DeFi protocol, World Liberty Financial. The report explains that analyzing WLFI offers some rare insights since it represents the intersection between DeFi and politics. As it happens, a big chunk of WLFI's supply is concentrated among a few insiders, including Trump family entities, political advisors, and affiliated investors. Now, these insiders have access to very different insights than plebs like us do, especially around political and regulatory shifts that can move markets. In other words, sudden moves from them can signal upcoming changes in the crypto market. The report then explains why this really matters. On that fateful day of the 10th of October, WLFI faced heavy selling pressure starting at precisely 3:32 p.m. UTC. More than 5 hours before the broader crypto market crashed. Given what World Liberty's insiders could have known, this raises the question of whether WLFI's sudden downside move was actually an early warning shot. To figure out if this is true, the report explores several standout metrics, the first being WLFI's funding rate. Now, for those unaware, the funding rate is basically what long traders pay short traders in perpetual futures markets to maintain their positions. Notably, WLFI's funding rate was 2.8x higher than BTC's, at 2.8% versus Bitcoin's 1% in the 8 hours prior to the crash. That puts WLFI's annualized borrowing costs at roughly 131%. This suggests long traders were highly speculative, despite pressure to close positions to avoid losses, either due to WLFI's underperformance or the cost to maintain the position itself. Now, at first glance, you might be thinking that if traders are happy to go long, even with these mounting pressures, then this is surely a bullish signal. On closer inspection, though, it actually presents several warnings.
Warning, warning.
Yes, the substantial premiums being paid by long position holders shows conviction, and that's good. However, it also shows vulnerability. When that conviction doesn't pay off, these long traders are basically screwed. And since perpetuals markets run on huge amounts of borrowed capital, this means the downside volatility can be extreme, just like it was in WLFI's case. The second problem is that WLFI's 2.8x premium over BTC shows that long traders were facing significant pressure compared to the broader crypto market. In other words, there was far more risk of World Liberty's investors being liquidated. Thirdly, the report notes that positions with high funding rates become more unstable over time, making them more and more sensitive to any price fluctuations, especially when they're to the downside. So, what all of this means is that WLFI positions were at serious risk of liquidation, well before positions tied to BTC. As such, one could argue that WLFI's price action could have served as an early warning, especially given how the rest of the crypto market tanked just 5 hours later. Makes you wonder what World Liberty's insiders saw coming that the rest of us didn't, right?
I saw it coming.
The thing is, traders who spotted this warning didn't have much time to react. Naturally, those who stayed most up to date had the best chance to reposition. And if you want to follow market developments like these in real time, then you can easily do so by joining the Coin Bureau's Telegram channel. That's where we share the latest breaking news, provide deep dive alpha, and give you the most important market updates, all pinged directly to your device so you don't miss a thing. So sign up today using the link in the description or the QR code on screen now. Okay, the next section of the report digs into other metrics to assess whether WLFI really was an early warning shot to the broader crypto market. The report notes that at 2:57 p.m. UTC on the 10th of October, the day of the mass liquidations, President Donald J. Trump posted on Truth Social that the US would impose 100% tariffs on China. Just 3 minutes later, something truly insane happened on-chain. You see, the report explains that right before the announcement, WLFI's average hourly trading volume was roughly $22 million, which is pretty standard for a token of its size. But at 3 p.m., just 3 minutes after the announcement, trading volumes skyrocketed to over $474 million. That's a 21.7 times increase on the baseline. And to really put that into perspective, the report adds that, quote, in 1 hour, more WLFI changed hands than in the previous 20 hours combined. The report explains that this move was far too sudden and far too extreme to be ordinary retail investors, meaning it must have been large token holders exiting fast. In other words, those insiders we talked about earlier. Put simply, insiders with political connections had plenty of opportunity to position themselves ready for the announcement and then act fast once the news broke out. In other words, these traders could have potentially avoided insider trading allegations by positioning themselves in advance of the news breaking out and only acting once the news actually became public. Early enough to take advantage, but not too early that it breaks any laws or raises too much suspicion. Regardless, this triggered WLFI's first sudden move to the downside. What's crazy, though, is that this happened precisely 5 hours and 18 minutes before BTC started its nosedive. During those 5 and a bit hours, BTC was still trading fairly steadily at around $121,000, while WLFI signaled that something was very wrong beneath the surface. Then, at 8:50 p.m. UTC, Bitcoin finally caved under the pressure and began its downward descent, dragging the rest of the crypto market down with it. What's wild, though, is that while Bitcoin's realized volatility hit 84%, which is already extremely high, WLFI's volatility surged to a jaw-dropping 671%, roughly 8 times higher. Now, this is important because high beta assets are more sensitive to systemic risk and often move first as a result. An 8x volatility gap means WLFI is roughly 8 times more sensitive to downside than Bitcoin. So, a 1% BTC drop implies an 8% drop for WLFI, and a 5% BTC drop implies a 40% drop for WLFI. So, with that in mind, a similar pattern played out on the 10th of October, although less extreme. BTC's price fell about 15%, while WLFI dropped 55%, putting WLFI's volatility at roughly 3.7 times that of BTC's. Notably, if the same 8x rule applied in full, then WLFI would have fallen by 115%, or put differently, it would have gone to zero. But although this technically means things could have been much worse for world Liberty investors, the takeaway is clear. WLFI was far more sensitive to emerging systematic stress, which is why its price fell well before BTC even started moving down. This is why the report notes the volatility differential as a leading indicator, although one could argue that this may have simply been because WLFI's market cap is considerably smaller than BTC's, which naturally makes it more volatile anyway. Regardless, the next part of the report examines the cascade behind the 10th of October drawdown and compares how badly different cryptos fell. The report points out that while WLFI's low market cap meant it couldn't impact Bitcoin's liquidity, it may have triggered a domino effect. That's because crypto derivatives traders will often use cross-margin systems where a trader's entire portfolio is used as collateral for their leveraged trades. So, when the value of one asset drops sharply, this can have an impact on that trader's broader portfolio. This can result in a chain reaction. First, the decline leads to collateral devaluation. Basically, as WLFI fell by 50%, the overall value of leveraged traders' collateral dropped along with it. This caused traders to breach maintenance margin requirements, triggering margin calls across all their positions. Then, to meet these requirements, traders can be forced to liquidate more liquid assets like BTC or ETH. These forced sales then put downward pressure on the broader market, which then triggers additional margin calls for other traders. Put simply, this means the interconnected structure of leveraged traders holding WLFI resulted in a death spiral that sent the entire crypto market into freefall. Next, the report compares the order book liquidity depth of WLFI and BTC, focusing on liquidity within 20 basis points, or 0.2%, of the market price of either asset, since that's basically the real liquidity that can absorb trades before prices start to move. During the massive liquidation event, WLFI's order book liquidity within that 20 basis point range fell over 99%, from about $1.8 million to just $10,000. But what might surprise you even more is that in that same period, BTC's liquidity in that range dropped a massive 96%, from $311 million to just $11 million. Now that is insane given the sheer volumes that flow through BTC. In any case, the report explains that, quote, "This highlights a key market microstructure dynamic. Liquidity provision is asymmetric across market conditions. Put simply, when markets are calm, liquidity isn't an issue. But under stress, traders pull their liquidity all at once. The result is that liquidity depth basically evaporates right when the market needs it most. In WLFI's case, this essentially added another factor to the death spiral I mentioned earlier, where the margin calls being triggered caused traders to sell their assets and not just WLFI, resulting in depleted order book depth, which increased the impact of any further sales of each asset. Logically, this then triggered even more margin calls. By the time BTC collapsed at 8:50 p.m. UTC, three major factors had already converged. Leveraged traders were under elevated stress, order book liquidity had depleted for multiple assets, and sentiment among crypto investors had already become more bearish. When combined, there was nothing to prevent the automated liquidation cascade that quickly followed. The report also looks at small, mid, and large cap cryptos to show how different brackets were affected, although their idea of small cap still means multi-billion-dollar market caps. Heck, the smallest crypto mentioned is Aave, sitting at around $1.8 billion at the time of shooting. So, I guess that anything under $1 billion counts as a microcap now.
Who knew?
Anyhow, these so-called small caps, specifically Uni, Aave, AVAX, and Link, saw declines between 62% and 71% during October's liquidation event, while Sol, apparently a mid-cap, fell by 32%. ETH, the only large cap, dropped 20%, while BTC, labelled a reserve asset, fell by just 15%. Regardless of the report's rather odd bracketing, the takeaway is still clear. Smaller cryptos are more sensitive to downside pressure from higher leverage, thinner order books, and concentrated retail ownership. They feel market stress much sooner than larger assets and tend to decline first. That said, though, WLFI was hit hours before other small caps. The report argues that this shows how highly leveraged tokens with political ties can provide early warning signals for the broader crypto market. Now, the next part of the report examines the structural characteristics of political tokens. The report reiterates that a large share of WLFI was concentrated among a small number of insiders. More importantly, though, these insiders could pass information to other insiders within minutes. That's because holders of politically affiliated tokens typically move within the same circles, attending similar events and briefings, and can collectively respond to any policy signals. They're almost certainly all in the same WhatsApp groups too. Whatever the case though, the result is information clustering that sets insiders apart from other traders. The report notes that October's liquidation event raised serious questions about how information was transmitted between WLFI holders and provides a timeline to really put things into perspective. At 2:27 p.m. UTC, large short positions began appearing across futures markets. 30 minutes later, at 2:57 p.m., the China tariff news broke. Just 3 minutes after that, at exactly 3 p.m., WLFI's trading volume shot up by more than 21x. 32 minutes later, WLFI's price began to tank while BTC remained unaffected. It wasn't until 8:50 p.m. that BTC finally broke and the market descended into chaos. Essentially, this timeline helps explain how WLFI crashed so hard so quickly. Clearly, this wasn't individual retail investors reading the news the second it broke and analysing the potential market impact before making trading decisions, all within 3 minutes. Instead, it points to a coordinated group acting on privileged information before retail traders even had a chance. The report also notes that political tokens tend to have thin liquidity and higher leverage. WLFI's sell pressure couldn't be absorbed by its shallow $1.8 million order book, while its 131% annualized funding rate was unsustainable for leveraged long traders. And with volatility running 8x higher than Bitcoin, WLFI showed how vulnerable political tokens are, even to small price drops. Logically, these traits are meant to drive speculative upside potential, but as we all know, tokens can fall just as fast as they can rise, if not faster. As seen during the liquidations, the lower the market cap, the greater the downside risk. This is why WLFI fell first, hours ahead of the rest of the market. In any case, the report notes that, quote, "The October 10th Cascade demonstrates that political tokens function as information transmission mechanisms. WLFI's initial sell-off basically gave a 5-hour and 18-minute warning that pain was coming. And while many have disregarded WLFI's market impact due to its low market cap, its high leverage positions and its political ties made it a key indicator that, in retrospect, we shouldn't have ignored." In the report's words, quote, "In interconnected leverage systems, the weakest structural link provides the earliest signal of systematic stress." Wise words. Anyhow, now that the crypto market is left licking its wounds, leverage will start to rebuild. If we see more political tensions, which, let's face it, are highly likely, then WLFI may have inadvertently provided the perfect template for spotting early warning signals from political tokens before it's too late. So, if we want to avoid getting wrecked again, then we should probably be watching political tokens very closely, paying extra attention to any spikes in volume, any divergences in volatility, and any funding rate stress. If any of these materialize again, then, well, I think you can work out the rest. And with that, folks, we've reached the end of the report, and I'll remind you that you can find the full thing in the description below. For now, though, you're probably wondering what this means for the future of the crypto market. Well, we think there's a few important lessons to be learned from today's report, and the first lesson is the impact that smaller cryptos can potentially have on the broader market. We all know that the crypto market is largely driven by BTC's price action, and given that tokens like WLFI are much smaller, it's easy to assume that this extra volatility is to be expected. And to be fair, this is still the case. That said, though, we should probably be more aware of how this volatility also makes it easier to trigger liquidations. And as we now know, these liquidations can have far-reaching implications for cryptos much larger than the one in question. If this shows anything, then, it's that leverage is now deeply rooted in the crypto market, and this can have unexpected consequences that most traders wouldn't even consider. Another lesson that we should take from this is how whales with large allocations can impact a crypto's price when they decide to dump their tokens. Now, to be fair, this is something that almost every crypto investor is well aware of, but nothing really brings that risk to light more than seeing it happen before your very eyes. And this relates to another important lesson, and that's to be aware of who these whales are. Unfortunately, this is usually easier said than done, but any information you can uncover on X or in news articles can reveal a lot about an investor's intentions, especially for political tokens like WLFI. It's not exactly uncommon for politicians to prioritize their own interests, which puts it rather politely. And this brings us to the biggest lesson of all. Never, ever trust a politician. WLFI proved how insiders can pose a real threat to the average investor, and the evidence is pretty clear. Political insiders positioned themselves in advance and acted almost in unison in just 3 minutes, over 5 hours before BTC collapsed, suggesting WLFI's insiders may have helped trigger crypto's biggest liquidation wipeout on record. In other words, President Trump may have helped spark the bull market, but his DeFi protocol seems to have stopped it in its tracks. First he giveth, then he taketh away. Funny how that works, isn't it? Alright folks, that's quite enough controversy for one video, but hey, if you want more, then why not check out this one right over here, which explores why Bitcoin was in the Epstein files. Yes, really. And if you're one of the many people wondering why your altcoins underperformed, then we may have the answer for you in the video right over here. Okay, thank you all for watching, and I'll see you again soon. This is Guy, signing off.